Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, October 2nd. The US government remains shut. Friday's jobs data will likely not be released on Friday. But the weak ADP report from the US yesterday should help keeping the Fed doves in charge of the market and support equity valuations along with insatiable appetite for the big technology companies in the US and beyond. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the US government remains shut for the second day, which means that the BLS will likely not be releasing the September jobs data come Friday, but yesterday's ADP report from the US happily injected a good dose of dovishness into the market to help investors hold on for a few more days. The data actually showed that the US economy didn't add any jobs in September, but lost 32,000 of them instead. Now, part of it was due to an adjustment related to government numbers that the data relies on, but putting together the latest jobs data from various data providers, we clearly continue to see weakening jobs data in the United States, not even mentioning that things could even get messier from here, as the US President Donald Trump is now threatening to fire thousands, if not hundreds of thousands of federal employees if they can't get themselves out of this shutdown situation. Voila. So the picture is rather gloomy. But not for investors, happily, because investors actually love the sight of those 32,000 job losses in the US last month because it gave a solid support, a solid reason to the dovish Fed expectations to carry on. As such, the US two-year yield that best captures the Fed expectations fell sharply yesterday after the release of the ADP data, and the 10-year yield fell to 4.10% along with some safe haven inflows into the US Treasuries. But honestly, risk appetite was clearly not hit yesterday by the US shutdown drama at all. Believe it or not, the S&P 500 and Nasdaq, they both traded at a fresh record high yesterday, and the AI narrative remained one of the major drivers of this bull market, with Nvidia hitting itself a fresh all-time high level as well. On top of that, CoreWeave, which is the Nvidia-backed AI cloud provider that recently went public, remember, helped fuel the momentum yesterday after announcing another major deal earlier this week with Meta. And Google and Apple on their end also announced new smart home devices that will be fueled by AI as well. So the Magnificent 7 was up by 0.57% yesterday. And note that many investors now think that Magnificent 7 is outdated, as it also includes Tesla and Apple. It doesn't necessarily include this year's AI darlings like Oracle, for example, but the idea and the narrative remains pretty much the same. The big technology continues to fuel the rally, and that despite high valuations, and prospects of lower interest rates from the Fed in the coming months help grandly. So that's why there can hardly be better news for risk investors than the side of that negative jobs numbers in the US and weak economic data that help fuel the dovish Fed expectations and further fuel this AI rally. In the same way, dovish Fed expectations and insatiable appetite for big technology companies continue to shoulder the rally in Asia as well. Korean chip makers are up on news that OpenAI intends to buy their chips for their massive data center constructions in the US in the context of the Stargate project, while Alibaba jumped another 4% in Hong Kong after JP Morgan raised its price target by 45% to $245 per share. And this comes after analysts at Jefferies raised his target to $230 a share a few days ago. So does it sound too high to you? Well, at the current price, Alibaba is worth around half of what it was worth back in 2021. So if you think that the US big technology companies are worth buying despite their sky-high valuations and record high prices, you should be much more comfortable buying Alibaba at a 50% discount to its own all-time high level. Right now, though, note that Alibaba has stepped into the overbought market territory, and the letter suggests that the price went too high and too rapidly, probably, and there could be a minor correction down the road. A correction that should easily attract dip buyers and fuel the rally higher. I personally believe that it is just a matter of time Alibaba's share price shoots about 200 mark. In the FX, the US dollar remains under a decent selling pressure, both from the US shutdown and the dovish Fed expectations. But the news that the Fed's Lisa Cook will for now keep her job at the Fed gave some reassurance to dollar traders that the Fed's independence is not yet fully out of the window. So the letter will probably not prevent the US dollar from weakening further if the US shutdown story extends, but it is somehow good news for those who are so discreet about the Fed's independence, which means everyone. Now, on the shutdown front, bets on Polymarket assess a 40% chance for the shutdown to last more than 2 weeks, which would make this month's shutdown one of the longest. So if that's the case, the US dollar should continue to remain under pressure. The euro dollar bull should find enough fuel to send the pair above the 118 resistance and extend the rally to 120 psychological level earlier than my prediction for the first quarter of next year. Note that the latest data is also supportive for further euro appreciation because the September early inflation numbers from the euro area that were released yesterday actually confirmed a slight uptick in headline inflation from 2 to 2.2%, cementing the idea that the European Central Bank doesn't need another interest rate cut this year. And the chief Christine Lagarde said yesterday that inflation is quite contained right now in both directions. So that was another way of saying we will just keep steady for the moment. Now, across the channel, cable could also consolidate near the 135 level on the US dollar weakness, but conviction here is softer than for the euro, mind you, given the lack of appetite into UK's autumn budget announcement that will probably be another ugly moment for UK's growth expectations. And here, the higher the UK's borrowing costs rise, the narrower the fiscal headroom for Rachel Reeves' government, and the stronger the need for either tax rises or spending cuts, or both, which are both negative for growth expectations and unappetizing for sterling. Now, in other majors, Japanese yen and the Swiss franc obviously continue to amass safe haven flows in this US shutdown context. The dollar yen tested its 100-day moving average to the downside, that's near 146.50 level, and should be in a strong position to extend this move to 145 level, while the dollar franc consolidates just below the 80-cent psychological mark this morning. Now, if the franc is not gaining more than that, it is certainly because of the news earlier this week that the Swiss National Bank made its first meaningful franc sales in 3 years to soften the currency. So note that the intervention here remained quite softer compared to the ones that we saw back in 2020. But the simple fact that the Swiss National Bank actually started playing beyond the interest rates to soften the Swiss franc means that it has probably had enough with the franc's strength and that it has no other option really than to provide francs to the FX markets to soften its value, whether it pleases the US or not. As such, I believe that there will be more incentive from here to intervene through direct FX interventions in the coming months than cutting the rates below zero to avoid the negative side effects of below zero interest rates on the Swiss economy. And the latter means that gains in Swiss franc will hopefully remain limited during this US shutdown period, and other safe haven assets like Japanese yen and gold will look more appetizing for investors looking for safety. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.